morning and welcome to this week's Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. And this week I'm delighted to be joined by Leah Bramwell from our Chief Investment Office. Morning.
Morning, Jane. Thanks for having me again.
Leah is our Head of Tailored Investment Solutions and she's here to talk with me about what's going on in the markets this week to hopefully cut through a bit of the noise, demystify what's going on in a simple and easy to understand manner, and then hopefully you can feel a bit more informed, more confident and more in control of your financial future. So this week, while the battle over the Strait of Hormuz rumbles on and the energy shock continues to dominate, we're actually going to focus on some different reactions to that energy shock inflation that we've been talking about in the last couple of weeks, that supply side shock. And in particular, this week, we're going to look at what that means for interest rates and particularly the fact that the 10-year UK gilt, the yield on that gilt is approaching 5%, which is the highest level we've seen since about 2008.
Exactly right. So, as you say, we've had some developments on the interest rate front this week. We've had central banks meeting.
Yeah, all three.
So, lots of central bank news floating around to go alongside what's continuing to rumble in the Middle East.
Great. Well, let's grab our coffees and let's dive on in. Do you want to briefly touch on the Strait of Hormuz and what's going on in the war?
Yes.
Before we dive into interest rates? Or
well, by the time this goes out, we may be well out of date.
You never know.
You never know. It's obviously changing very rapidly.
Yeah.
And lots of rhetoric flying around on deadlines and no longer deadlines and extended deadlines. And I think the main thing to bear in mind is that at the moment, at the time of recording, things are still very uncertain.
Yep.
Things are, I would say, no longer escalating, but not de-escalating either at the moment. And markets are reflecting that level of uncertainty and continue to be very volatile.
Okay, thank you. So perhaps I don't know if I can call it the bigger story this week, but let's turn to what's happening with interest rates. And in the last couple of weeks with Tom, we've talked about how geopolitics can affect the path of interest rates. Since then, as we mentioned at the beginning, the UK, the US and the European central banks have all met and have all chosen to hold rates steady. But the reactions couldn't have been more different, really, from what I could gather. So perhaps that's this week's real story. So would you just give us a little bit more information about that? Tell me a little bit more.
Absolutely. So I think the central bank guidance and commentary that came out after the meetings was probably the more interesting story for investors rather than the actual holding of rates. And investors were really looking deeply into the commentary that came alongside for any clues on how the central banks were thinking about things. I think at this juncture, it's really important to note that it's very, very clear that it's an uncertain environment. And for most central banks, the sensible option is to take a step back, hold rates and see what's going on.
Take a deep breath.
Take a deep breath, exactly. Yeah. They are facing a significant supply side shock on energy prices, which can have potentially significant impacts in inflation, varying by country. So in the US, slightly more dependent on their own energy, whereas the UK and Europe both more impacted by global energy prices. So perhaps explaining some of the differences in the level of concern around the impact of rising prices on domestic inflation.
So let's go into the UK in a little bit more detail. So the UK gilt markets were at the centre of the reaction. So what's going on with the UK?
Yes, exactly. So we've gone from last month, we had a split vote from the Monetary Policy Committee, which is the committee which sets interest rates at the Bank of England. We had a split vote, a very tight vote on whether the Bank of England was going to cut rates further. This month, we had a unanimous 9-0 vote to hold rates where they were. Okay. And investors interpreted that as a move to a more hawkish position from the Bank of England. Hawkish being inclined to raise rates, dovish being inclined to reduce rates.
In the past, I have to remember this by hawks fly high,
exactly.
Doves fly a bit
Doves
lower.
fly lower, exactly. So investors interpreted this as a shift in tone from the Bank of England, moving towards higher interest rates rather than lower interest rates.
That's quite a considerable move when you say last month, they all vote. It was a bit more of a split vote rather than they all voting for hold this month. Then.
Exactly. And at the beginning of the year, markets were expecting two further interest rate cuts from the Bank of England. And markets now, following this meeting last week, are pricing 3 increases to interest rates. So a huge swing from where we were 3 months ago to where we are today, a massive change. And I think we are feeling that is not at all reflective of the fundamental state of the UK economy.
Right.
Growth is slow, unemployment is rising, and inflation prior to this shock had been moderating. So it's our view that the Bank of England will look through this shock and they will continue to focus on the domestic economy. Now, obviously, if this shock endures and carries on and the supply side becomes more constrained and we look at sort of second and third order effects, and inflation can be impacted heavily by that, then the Bank of England may need to act.
But that's a different scenario
than
the one we're currently facing.
Exactly, than the one we're currently expecting is our sort of base scenario.
So the impact on gilts, and so this is UK government gilts. What's the situation there? How's this playing out?
Yeah, so gilt prices have come down.
Yep.
Yields have gone up. So yields and prices for bonds move inversely. So we've seen interest rates go up. So the return on offer from gilts has increased as prices have come down. And we think that's a really compelling opportunity for investors at the current time.
Yep.
Some of these levels we haven't seen since sort of 2008.
Yep.
And we think that that's a really good opportunity for clients with a long-term horizon to look through this volatility and to top up in some areas of the market there.
Because if I think about it, I've got some money in the building society, which is not only anywhere near 5%.
No, exactly.
And I'm paying tax on that interest rate that I'm earning as well.
Exactly. So if you've got money in a bank or a building society savings account, it's highly likely that you're not getting anywhere near that level. Now, if you're very proactive and you've moved around and you found the best deal, it's possible that you're getting somewhere close to that, but it is taxable for most people. Whereas if you were to invest in a gilt, and there's different components of return of a gilt, which we can touch upon, you're much more likely to get a much higher level of post-tax return.
Okay, so you mentioned there the different components of the return you get from a gilt. So I'm guessing you're talking about the mix of the yield or the coupon, which is the interest rate, isn't it?
Exactly. So if you think of a gilt, there's 2 elements of a return. You've got your interest rate, the coupon, as you say, and then you've got any capital gain associated with holding a gilt. So when you buy a gilt, you will pay a certain price. Let's say you pay 90 pence for a gilt. When it redeems, it will
redeems and matures.
And matures, exactly. Once, basically, when the government pays you the money back that you have lent it, it will redeem at 100 pence in the pound.
Right.
And so you've got that capital return, which might be split over a number of years, and then you've got the annual return coming from your coupon, your interest rate.
Right. And those two things combined, the yield,
make your overall return from holding your gilt.
Yeah.
Now, it's interesting, UK gilts are not subject to capital gains tax on capital gains from a gilt. And so if you are somebody who is holding cash not in an ISA wrapper or within a pension wrapper, but in a taxable environment, if you are buying a gilt which has a low coupon, so there are gilts which have low coupons, and so more of that return comes from the capital element of the bond, then that is a very tax-efficient way of generating return.
Okay.
Particularly for higher additional rate taxpayers.
Okay, interesting, particularly pertinent at this time of year as we get towards the end of the tax year.
Exactly. And I think that's really, really important to note is there's a lot of noise going on at the moment in markets around the world, geopolitics. We're approaching the end of the tax year. We've got about 2 weeks left.
Yeah.
We really are advising clients that they need to think about their long-term goals, think about their long-term planning needs, and make sure that they're not distracted from ISA contributions, from pension contributions, from making sure that any taxable money is appropriately invested in the most tax efficient way to generate the best possible returns for themselves on a long-term view. It's really, really important not to lose sight of those things.
Yeah. So, I mean, of course, we're talking about UK residents, UK taxpayers, but definitely worth looking at what you're invested in at the moment, because there's always going to be tariffs or conflicts or COVID or something going on in the markets. So I guess in the same way that we are hoping the central bankers look through some of this inflation noise, likewise, we perhaps should be looking through this noise as investors and keeping going with our long-term plans. As Andrew Bailey said this week, keep calm and carry on.
Exactly right. And 4 weeks ago, all we could talk about was AI and AI disruption and which company, which industry was going to be next. And
we seem to have forgotten about that.
Everybody's forgotten about that.
I'm sure it'll be back. Don't worry.
I'm sure next month that will be the topic again.
So thank you very much indeed for your time. Let me just sum up what's in my Canaccord takeaway coffee cup today. I think I've got a whole bunch of gilts in there, maybe paying 5%. I'll perhaps have them alongside my double espresso, keep me going. So energy risk is still high, but markets are pretty orderly, I think we said. Central banks on hold, they're taking a breath despite what's going on in the world. And amongst all this noise, there are some high quality gilt opportunities out there, especially sort of in the 3 to 10 year maturity space, and probably looking genuinely attractive again.
Summed up perfectly, Jane.
Okay, great. So thank you very much for your time. I do hope everyone's enjoyed the Coffee Break podcast today. Don't forget to hit follow so you never miss an episode. We're on Spotify or Apple or lots of other podcast channels as well. And if you have any questions, you want to share your thoughts, please do drop us an email, coffeebreak@canaccord.com. Thank you very much.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.